We're a dedicated active management firm and don't believe that you can't beat benchmarks or that you can't outperform the passive funds. You've got to understand and anticipate your clients' needs and how they're changing. Have a plan and be disciplined. Don't cut your flowers and water your weeds.
When Robert Sharps was growing up in Western Maryland, his interest in business began early.
My dad got his Series 7 and became a stockbroker, which is how I got interested in the investment business.
Sharps joined T. Rowe Price in 1997 as an equity research analyst. Over the years, he built a reputation as a successful large-cap growth portfolio manager, growing a $2 billion strategy to more than $35 billion.
Even though my primary role was as a large cap growth portfolio manager, I was involved in different aspects of the business. Ultimately, Bill Stromberg asked me to transition my book and become part of the leadership team. And at that point, I'd managed large cap growth for 15 years and was ready for a new challenge.
That challenge came in January of 2022 when Sharps became CEO, stepping into the role during a volatile period for global markets, with the S&P 500 dropping more than 10% into correction territory. Under his leadership, T. Rowe Price remains committed to active management even as index funds and ETFs dominate investor flows.
We're a dedicated active management firm and don't believe that you can't beat benchmarks. In many instances, we are able to deliver excess performance, so better return even after fees.
Sharps is also focused on the future, expanding into private markets, scaling active ETFs, and integrating AI into research and operations.
AI will influence security selection, portfolio construction, financial planning.
From a small town in Western Maryland to the top of a $1.6 trillion global investment firm, Robert Sharp's story is one of steady ascent through patience, discipline, and the belief that thoughtful, active decision-making still matters.
Being disciplined and having a very long time horizon is really important. I see a lot of people that are unwilling to make investments and take risks when the return potential is the highest. And in fact, in some instances, go the other way.
So just tell me exactly what a mutual fund is. Your company has started as a mutual fund company. Well, what actually is a mutual fund?
A mutual fund is an investment company that pools resources from investors, and it's really designed to allow investors to achieve diversification, give access to a broader range of investments in a more convenient way, lower expenses, and obtain professional management.
Mutual funds were often known for picking stocks and thinking that the stocks would be better than the average performance. But then came along the index fund. So explain to us, are mutual funds where you have stock pickers, are they still very popular? And is it still attract a lot of capital compared to index funds?
Index funds have gained a tremendous amount of market share over the course of the last 15 to 20 years. Today, over 60% of managed U.S. equity assets are managed passively or managed in an index fund. We're a dedicated active management firm and don't believe that you can't beat benchmarks or that you can't outperform the passive funds. We've done a number of studies that have looked at the performance of our funds net of fees over rolling 1, 3, 5, and 10-year periods of time. And what we find is that in many instances, we are able to deliver excess performance, so better return even after fees.
Let's talk about another phenomenon that came along after index funds, which is ETFs. So index reflects, let's say, an S&P 500 index. You basically get what the S&P 500 index is if you go on that kind of fund. What is an ETF?
An ETF is also a mutual fund, but unlike a traditional open-ended fund, it's traded like a security, like a stock on an exchange. It has certain advantages relative to a traditional fund, and as a result, it's become increasingly popular, particularly in taxable accounts. So in addition to being able to have intraday liquidity, which to me isn't necessarily all that important for most investors that have a long time horizon, there's a tax benefit to owning an ETF relative to owning an open-ended mutual fund. As a result, particularly outside of retirement accounts, ETFs have grown very, very rapidly over the course of the last 10 or 15 years.
What is the wave of the future? Is it going to be an artificial intelligence fund or something? What is the next technological innovation that's going to change the mutual fund industry or make it different than it is today?
So while ETFs and separately managed accounts have really gained favor in taxable accounts, in retirement plans, in 401k plans, mutual funds continue to be the investment of choice. And largely because they're tax deferred, the tax benefits of ETFs don't matter. And there was legislation in 2006 called the Pension Protection Act that allowed a retirement date fund to become a default investment for an employer to default their employees into a target date fund, which really is a very elegant kind of set it and forget it solution that allows somebody simply to say, my objective is to retire in 2060. I'm going to put my assets in the T. Rowe Price Retirement Date 2060 fund. And what it does is allow you to accumulate assets, and then as you approach retirement age, it has a glide path that increases the allocation to lower volatility sectors such as bonds.
Okay, let's talk about 401ks or IRAs. Historically, they had to invest in publicly traded vehicles. Now there's talk in Washington about changing the rules so that IRAs and 401ks can put a certain amount of money into private funds. Do you think that's going to happen? You think it's a good idea, or you think it's a bad idea?
Well, it's already happened to some extent, and I think it's likely to happen to a greater degree over time. We, as a matter of fact, have invested in over 250 private placements in our mutual funds over the course of the last 15 plus years. So you can have private investments in mutual funds. Historically, you haven't had them in things like retirement date funds. There are challenges to incorporating illiquid private assets into defined contribution plans. One, as you say, you need a daily net asset value, so you have to calculate or estimate the value of the fund, including the value of the private assets that aren't marked to market real time. Two, you have to provide liquidity, daily liquidity for these funds. If plan participants want to make a change, if they leave, if they want to make an incremental investment. And by definition, illiquid private investments are illiquid, so you've got to overcome that challenge. Third, a lot of plan sponsors are very sensitive to fiduciary risk. There's been a fair bit of litigation in the defined contribution environment over fees or performance. And then finally, it's an extraordinarily fee-sensitive market. And as you know, the fees in private market alternatives are much higher than the fees in even active public equities, let alone passive equities. So ultimately, you'll need to solve for all of those factors, and the improved or enhanced investment return from incorporating private market alternatives will have to be substantial enough that it overcomes the higher fees.
Your predecessor bought a private debt fund a few years ago, as I recall, and I guess was that to provide your clients with the diversification, private credit being a theoretically higher rate of return than regular fixed income?
Yes. So we, at the end of 21, so right before I became CEO, we acquired a New York-based alternative credit firm called OHA. And they do a range of things: structured credit, including CLOs, stressed and distressed offerings, as well as multi-sector strategies and private credit. So private credit, basically like most private investments, you trade off liquidity for return, and you can get, again, depending on the deal, a point or two premium for a senior secured private loan or a private unitranche loan relative to a syndicated loan.
So after the acquisition was made, have you thought about other acquisitions, or is your growth going to be mostly internal?
Yeah, so we've had a great experience with OHA, and we've learned a tremendous amount. We would like to have a more substantial presence in private market alternatives. And there are really three ways to do that. You can make an acquisition like we did with OHA. You can develop it internally. We've done a number of private placements that have historically been in our mutual funds. We're leveraging that capability to create a late-stage venture fund. So that's an area of private market alternatives that we'll do organically on the T. Rowe Price platform.
Do you think today an asset manager like you can continue to thrive if you don't have a large presence in private markets?
So increasingly, the private market alternatives firms and traditional investment management firms like T. Rowe Price are competing for the same investment dollar. As a result of that, you've started to see convergence, and I think that that's a trend that's likely to continue. So for firms like T. Rowe Price, I think you're going to have to figure out ultimately how can you get access to private market alternative building blocks to incorporate into the investment solutions that you're creating, you're curating on behalf of all of your client types.
As you look at the economy, are you worried, or you feel the economy's in reasonable shape and the big beautiful bill will help it get in better shape?
So I have to say I've been surprised at how resilient the economy's been in the face of still relatively tight monetary policy. For a couple of years now, I think we've been anticipating looser monetary policy and more rate cuts, and they've been slow to come because inflation has been stickier or more persistent. It still seems to me as though there's a lot of uncertainty or lack of clarity with regard to how the tariffs will ultimately play out, what impact they'll have on consumption, whether or not they'll be inflationary. But the economy's been resilient, so I don't see any imminent signs of a recession.
How is artificial intelligence going to change your business, or not at all?
Oh, absolutely it will. I think, I think it will change most everything. There's a lot of things that we do that are either content refinement or content generation, right? On the business side, if we're competing for a new mandate, we respond to an RFP, right? We're using AI tools to compress the time and the cost of producing that proposal in response to the RFP. We're also using AI to review and refine investment management agreements and review and refine vendor contracts. So in a lot of ways, we're using it to make the business much more efficient, either faster, more accurate, or less costly. I think it's also informing better decision making. I'm a big believer in taking on new challenges and lifelong learning, and it wasn't something that that I'd really anticipated or that I'd been positioning to do.
Let's talk for a moment about T. Rowe Price himself.
Yep.
There was a man named Mr. T. Rowe Price. Who was he?
Thomas Rowe Price Jr. He was a Marylander born in Glendon, Maryland. I think he worked for a number of brokerage firms and ultimately founded T. Rowe Price in 1937. He founded the company on a handful of principles. One is putting clients first. Two is acting with integrity. And three is emphasis on fundamental research. And I think all of those things are things that we still hold dear today. And Thomas Rowe Price was an early pioneer. As a matter of fact, our growth stock fund, which is one of our flagship funds, which was launched in 1950, to my knowledge, was the first mutual fund that was launched dedicated to the growth style of investing.
Let's talk about T. Rowe Price today. What are the assets under management? How big is the firm?
$1.6 trillion.
The company's headquartered in Baltimore. Do you have your only office here, or do you have office elsewhere?
So we have 8,000 associates. About 5,000 of those are either here at our headquarters downtown in Harbor Point or in our corporate campus in Owings Mills, which is in Baltimore County. So we have a team of people there that are focused on supporting the business and have a unique set of capabilities. Then we've got a number of offices throughout Asia and Europe.
Okay, let's talk about your own background. So where were you born?
Yeah, I'm a Marylander, but I'm not from Baltimore. I was born in Cumberland, Maryland, in Allegheny County, which is the second westernmost county in Maryland.
And what were your parents? What did they do?
So my mother was a school teacher, a public school teacher, and my father's family was in the automotive business. They had a Chevrolet dealership. When my paternal grandfather passed away, my dad took over that business, but he wasn't all that interested in it and ultimately sold it. He got his Series 7 and became a stockbroker, which is how I got interested in the investment business.
Hey, so when you were growing up, were you an athlete? Were you a great scholar?
I did play tennis and was reasonably good. I played one singles my senior year. But outside of that, I'd say I wasn't a particularly distinguished athlete. And academics, I was smart enough to get by without a tremendous amount of effort. So I did, I wouldn't particularly distinguished as a student in high school either. Although I graduated near the top of my class in college, so maybe grew up a little bit. I don't know, maybe I had all my fun in high school.
So you went to college in Maryland at Towson?
At Towson University, yeah. It was Towson State at the time.
And what did you major in?
Accounting. Look, accounting is the language of business. I mean, I think it was a great foundation ultimately to get into investment research and eventually portfolio management, right? Creating financial statements isn't all that interesting, but if you know how they're made, you can do a pretty good job of using and analyzing them.
All right, so when you graduated from college, what did you do?
I went to work for KPMG in Washington, D.C. for 2 years. I worked in a consulting practice there. And then I went to University of Pennsylvania to Wharton to get my MBA.
After that, did you say, I want to be an accountant still, or I want to do something else?
When I left KPMG, I went with the idea that I wanted to get into an investment-related field. I wasn't certain exactly what that was, but I really wanted to use the MBA education and experience as a segue into the investment world.
When did you get your position at T. Rowe Price?
Yeah, interestingly, I interviewed for a summer internship position and got put on the wait list and ended up interning at Wellington Management Company in the summer of '96. I had a great experience there, but also stayed in touch with the folks at T. Rowe Price, and as I did the full-time recruiting process, ultimately chose to come to T. Rowe Price. So,
Okay, what year was that?
'97.
97. So what was your job at T. Rowe?
Was an equity research analyst, and I followed the financial services sector.
Okay, and so how many years did you do that before you kind of rose up a bit?
3 or 4, and then I was given diversified portfolio management responsibility. I spent the vast majority of my career as a U.S. large cap growth portfolio manager. We launched a strategy with $2 billion of seed money in 2001 that by the time I handed it over to my successor was over $35 billion.
So did that success make you a candidate to be the CEO?
Yeah, so I started in the business following financial services, and that included doing research on our publicly traded competitors, our counterparties, our clients. So I had a pretty good perspective into the business. And then the process of not only investing and building a track record, but also building a commercial franchise, going and doing finals presentations, and then meeting with clients and doing performance and portfolio positioning updates, I think gave me pretty good perspective on the commercial side of the business. I also sat on a group called our Equity Steering Committee, which is really kind of the cabinet, if you will, for the division head. And it gave me a sense for how we develop talent, how we set policy, those sorts of things. So even though my primary role was as a large cap growth portfolio manager, I was involved in different aspects of the business. Ultimately, Bill Stromberg asked me to transition my book and become part of the leadership team. And at that point, I'd managed large cap growth for 15 years and was ready for a new challenge.
He tapped you on the shoulder and said, you know, you're good at management possibly, and maybe you could rise up and be the CEO. Did that surprise you, or did you say, you know, I was waiting for you to ask me that for a long time?
No, it was a very hard decision. You know, it's a really different job, a really different set of responsibilities. It was one that we spent a lot of time talking about. It was one that, you know, I talked to some people that I respect a lot. You know, I spent some time talking to my father. Larry Culp's been a mentor to me. Spent some time talking to Larry Culp, and, you know, really tried to get a sense for what the difference between being an individual contributor and being a leader. I didn't really have much experience as a people leader at that point. So, you know, I thought really hard about, do I want to take this new challenge on? I'm a big believer in taking on new challenges and lifelong learning, and ultimately decided that it was something that I wanted to do. But it wasn't something that that I'd really anticipated or that I'd been positioning to do.
When you became the CEO, what did you spend most of your time doing? Dealing with clients, employees, investments? How do you divide your time?
I spend a lot of time engaging with clients. I think in order to develop strategy, you've got to understand and anticipate your clients' needs and how they're changing. I find a big part of this role is the ability to get things done through others. And in order to do that, you have to be credible, right? You have to build trust. Being disciplined and having a very long time horizon is really important. Don't cut your flowers and water your weeds.
Now, I assume because T. Rowe Price is a big employer in Baltimore, and you're the CEO, you're probably pretty well known in Baltimore, if not elsewhere. So if you go to a cocktail party in Baltimore, do people come up to you and say, hey, I don't know what to do with my money, got any investment tips? What do you tell people?
Yeah, I think giving financial advice without really having context of people's risk tolerance, time horizon, resources is probably not a wise thing to do. So I'll either deflect or use some generalizations, tell people to max out their 401k, ultimately to have a very, very long time horizon, those sorts of things, as opposed to offering perspective on my view of the market or any individual securities or funds.
So who manages your money?
I do.
You do?
I do.
So you, every day you're looking at it to make sure, and I assume most of it's in T. Rowe Price?
It is. My largest holdings are equity in our company, so T. Rowe Price shares. The fund that I used to manage, T. Rowe Price Large Cap Growth Fund, and then I own a number of our other mutual funds, and I've also invested in a number of OHA's funds.
Let's suppose I'm a student at Wharton now and I'm looking for a job. Why should I want a job at a company like yours or an investment company?
Our industry is really dynamic, right? Evaluating investment opportunities, I think, is intellectually challenging. Getting it right is very rewarding. If you're good at it, it can be lucrative. I think we have a great culture as a firm. When I think about T. Rowe Price's culture, we have a very long-term orientation. We think hard about delivering a great value proposition for our clients and putting our clients first. We really value intellectual honesty, collaboration. So it's a great place to come and learn. What I find is people that are attracted to active investment management want to be around other great investors. And I think our platform offers that.
If I showed up in your office tomorrow and said, look, I moved to Baltimore, I have a little cash, I'm 50 years old, I don't really need the money, I have $1 million, what should I do with $1 million?
Yeah, again, I think to some extent it probably depends on your risk tolerance, but there are a number of T. Rowe Price funds that I would wholeheartedly recommend. Global Focused Growth, Capital Appreciation, our U.S. structured research strategy that's managed by our research analysts. All of them have very strong long-term track records, and I think for somebody with a long time horizon would make for very, very good investments.
What's the best investment advice you've ever received?
It's hard to pinpoint one thing. Being disciplined and having a very long time horizon is really important. I see a lot of people that are unwilling to make investments and take risks when the return potential is the highest, and in fact, in some instances, go the other way. So I'd say have a plan and be disciplined. It took me a little while to learn that just because something was down quite a bit doesn't make it attractive, and just because something's up quite a lot doesn't mean that it's expensive or that you've missed it. We had a former portfolio manager that used to say, don't cut your flowers and water your weeds. And we've certainly been through a period of time where it's paid off to let your winners run. And I'd say through my career as a large cap growth portfolio manager, that was a pretty important element of my process.
In your observation, what is the biggest mistake the average investor tends to make?
Yeah, I think de-risking during a period of time where risks are very high.
So
it just destroys your long-term returns.
So do you enjoy this job?
I enjoy solving hard problems. I have a great leadership team that I work with, and I really enjoy working with and developing them and working with and developing their teams. Now, look, I have a passion for this company. I've been here this month for 28 years. I love the business and the industry, but there are obviously times that it's hard. I think when you're a CEO, ultimately you need to make very difficult decisions about resource allocation. Sometimes you need to deliver hard messages when the results aren't there. And I think anybody in the seat doesn't enjoy that part of it, but I think they understand that it's an important part of the responsibility.